The Precious Metals Week in Review, February 26, 2016. Brought to you by Precious Metals International. It was yet another volatile week in stock markets as both the US and Europe continued to react to weakening global economic data. The number of Americans filing initial claims for state unemployment benefits spiked by 10,000 claims last week to a new seasonally adjusted level of 272,000. The prior week's claims were unrevised, and analysts at the U.S. Labor Department said there were no special factors influencing the data. The data for last week marks the final cut for inclusion in the February non-farm payrolls report, which will be closely watched when it is released next Friday for indications on the U.S. Federal Reserve's next moves. Fourth quarter GDP in the U.S. was revised to show a slightly higher increase than the initial report of 0.7%. The Commerce Department reported on Friday that its second GDP estimate for the fourth quarter showed a growth rate of 1.0%. Economists had been projecting a downward revision to 0.4%, so the increase took them by surprise. The data revisions were not all good, however, as the new estimate showed that businesses built up an estimated $81.7 billion in inventory rather than the initial report of $68.6 billion. The larger build in inventory could signal that the first quarter GDP growth for 2016 could be lower than expected as businesses work through the excess inventory instead of placing any new orders for goods. On Friday, in a research note, German-based Deutsche Bank said there are rising stresses in the global financial system, in particular the rising risk of a U.S. corporate default cycle and the risk of a sharp one-off renminbi devaluation due to the sharp increase in China's capital outflows. Buying some gold as insurance is warranted. Deutsche Bank continued discussing current price levels for gold, saying a bit like insurance, which is often a grudge purchase for many, some investors may balk at the current levels. We would, however, argue that given the plethora of negative deposit rates globally, the holding cost of gold is now negligible in many jurisdictions, and therefore gold deserves to be trading at elevated levels versus many other assets. Japan's core consumer price index (CPI) was unchanged in January from a year ago. Steadily declining energy costs continue to push consumer costs down, making the Bank of Japan's 2% inflation target increasingly harder to reach. The BOJ now expects to hit its 2% inflation target by the first half of fiscal year 2017, but that projection is likely overly optimistic, especially if energy prices are slow to recover or perhaps even decline further amid ongoing global oversupply. The so-called G20, the group of the world's leading developed and emerging economies, meets in Shanghai beginning this Friday, and both the International Monetary Fund, IMF, and the Office for Economic Cooperation and Development, OECD, have issued calls to the group for a more coordinated response to stagnant global economic growth. The OECD, in particular, noted that we are in the 8th year since the start of the global financial crisis, and we have not reached the 4% cruising speed that we had before the crisis. The speed, the appetite, the courage for reforms has waned. We should pick it up and do exactly the opposite. Both the IMF and the OECD noted that central banks have essentially run out of ammunition to spur economic growth, with the IMF saying, on the demand side, accommodative monetary policy remains essential where inflation is still well below central banks' targets. However, a comprehensive approach is needed to reduce over-reliance on monetary policy. In particular, near-term fiscal policy should be more supportive where appropriate and provided there is fiscal space. In Europe, geopolitical and economic uncertainty continue to plague the European Union. The political atmosphere in the UK seems to be devolving as the referendum on the so-called Brexit approaches. London wants to renegotiate its place in the EU and intends to hold a referendum on whether to remain in the EU on June 23rd. In a research note released this week, HSBC said it will be a momentous decision. A vote for Brexit would have potentially huge consequences for all asset classes. Uncertainty could grip the UK economy, triggering a potential slowdown in growth and a collapse in sterling. The research note also stated that the unknown is how economically destructive and drawn out the transition phase would be. Comments by Iran this week that any output freeze for crude oil was a joke continued to keep downward pressure on the price of oil, despite a decline in fuel stockpiles that briefly sent prices higher. Despite the continued downward price pressure due to pervasive uncertainty in the Middle East, crude oil did manage to break back through $30 on hopes that OPEC might finally be considering moves which could stabilize oil prices. The euro started the week off with a brief but vertical plunge against the US dollar when it opened. The euro quickly recovered from the initial plunge, but then moved steadily lower through Monday and then traded basically sideways in fits and starts until Friday. On Friday, the euro renewed its plunge against the US dollar and will close the week lower. The Japanese yen saw a slight bump to the upside against the US dollar to start the week, but it soon began moving lower into Monday morning. Late Monday, the yen surged higher and then trended higher until it reached its peak on Wednesday. The yen began moving lower on Wednesday, and a sharp decline on Friday will ensure that the yen will also close the week lower against the US dollar. In Europe, tensions continue to increase over the ongoing migrant crisis, which has resulted from the Syrian civil war and conflicts elsewhere across the Middle East. In Brussels this week, Interior and Justice ministers from across the European Union (EU) met to discuss plans which Austria and the Balkan nations plan to implement, requiring fingerprinting of all migrants entering their countries and turning away anyone found to have no passport or any other valid documentation. Greece and Germany were notably absent from the meeting. They were not invited by the other attendees, and both heavily criticized the talks. Reuters said, quoting the Greek foreign minister, that Greece recalled its ambassador in Vienna after learning it had been excluded from the meeting. Greece has been at the forefront of the migrant crisis because there has been such a massive influx of refugees entering Europe through there. Any plan which results in migrants being denied entry or relocation to another area in Europe effectively strands those people in Greece, which has yet to recover from its economic meltdown during the financial crisis. A massive influx of the dislocated and disaffected out of the Middle East and into Greece, amid continued high unemployment and an already struggling economy, could very likely be a recipe for disaster. Greek Prime Minister Alexis Tsipras said on Wednesday that Greece was in danger of becoming a permanent warehouse of souls if other EU member states did not shoulder more of the responsibility for relocating the refugees. Mr. Tsipras said he could take the step of blocking further EU agreements if a solution to the crisis is not found. In addition to divisiveness over how to handle the migrant crisis, the EU is divided on the way to properly handle slowing global economic growth. German Finance Minister Wolfgang Schäuble said at the G20 meeting in Shanghai this week that fiscal and monetary policy have reached their limits. If you want the real economy to grow, there are no shortcuts which avoid structural reforms. Mr. Schäuble said Friday, talking about further stimulus just distracts from the real tasks at hand. We therefore do not agree on a G20 fiscal stimulus package, as some argue in case outlook risks materialize. The debt finance growth model has reached its limit. It is even causing new problems, raising debt, causing bubbles, and excessive risk-taking, zombifying the economy. Ignazio Visco, the governor of the Bank of Italy and a European Central Bank Council member, bluntly disagreed with Schäuble, telling CNBC, "I don't believe that. It is needed this response on the monetary side. There is no sign whatsoever for the time being that there are unintended consequences and that asset prices will increase dramatically. We are in a state of downward risk on the activity side." Mr. Visco noted that reforms are very important, but you have to have specific structural reforms for each country or each area in the world. On Wednesday, analysts at Citigroup said in a research note, "We are currently in a highly precarious environment for global growth and asset markets after 2 to 3 years of relative calm. The most recent deterioration in the global outlook is due to a moderate worsening in the prospects for the advanced economies, a large increase in the uncertainty about the advanced economy's outlook, notably for the U.S., and a tightening in financial conditions everywhere." The note continued saying, "A material slowdown in the U.S., even short of a recession, would still be a major headwind for the world economy. At this point, it could make a global recession, according to our definition, almost unavoidable." The damage to global growth conditions would come from three sources: deteriorating financial conditions globally, weaker demand from the U.S., and weakening consumer and business sentiment more broadly through contagion. In its own research note released on Friday, Deutsche Bank noted much the same thing and said that, given current circumstances, buying some gold as insurance is warranted. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, February 26, 2016. Brought to you by Precious Metals International.